How did Warren Buffett make his first million? Hint, it wasn't diversification. Let's dive in. So Warren Buffett was born on August 30th, 1930 in 2023. That'll make him 93 years old. And he is worth approximately $116 billion. But let's go back to the beginning and really dive into how he started his career and really how did he build his wealth. So in 1954, at age 24, he started working for one of his professors from Columbia University in New York. That was Ben Graham. Ben Graham had an investment firm, and Warren Buffett started making $12,000 a year, which is actually equivalent to about $136,000 a year in 2023 dollars. So not a bad way to start your career after school. Then 2 years later, in 1956, Graham decided to retire, and Buffett established Buffett Partnership Ltd. And what he did was he charged a different fee than a lot of other people were charging. Just for context, a lot of wealth managers and financial advisors will charge what's called an AUM fee, assets under management, and it's usually about 1 to 2%. What that means is, let's say you give $100,000 to an advisor and they charge you 1%, they're going to take $1,000. If it's $1 million you give to that advisor, they're going to charge you $10,000. So what he did is he charged 0% AUM, but he charged 25% commission on any returns greater than 6%. So really a put your money where your mouth is situation. Now, what Benjamin Graham taught him was if you really want to build your wealth, you need a focused portfolio. If you have too many stocks or too many businesses, you're going to create too much diversification, which is all about protecting your wealth, and that's not how you build your wealth. So what he did was he would find really high quality businesses with a margin of safety greater than 50%. In TYKR, if you join TYKR, you can see we calculate that margin of safety. We look for the fair value. And just for context there, if you're interested, we are open source. You can go to TYKR.com. There's a little education tab. You can scroll down and there's calculations right there. But it shows you how we calculate that fair value. So Graham taught him this. You want to find great companies that have a margin of safety, again, greater than 50%. Essentially what that means is buying $10 bills for $5. So go a year later, 1957, Warren Buffett bought his first house, which was a 5-bedroom stucco house in Omaha, Nebraska, for about $31,000, which is equivalent to about $357,000 in 2023 money. And as of 2023, he actually still lives in that same house. In 1959, at age 29, he met his business partner, Charlie Munger. In 1962, at age 32, his net worth exceeded $1 million, which in 2023 dollars is about $11 million. But that was made through the commissions from his investment firm. Then that same year, he started buying shares of Berkshire Hathaway, which was a textile or fabric manufacturing company that was actually founded in 1839. Then in 1964, Berkshire Hathaway stock started dropping, and Buffett had the opportunity to buy the company, so he decided to do exactly that. Then in 1969, Buffett actually decided to close down his investment partnership, admitting to investors he's run out of good ideas or good businesses to invest in. And at that moment, he decided to go all in on one stock, that stock being Berkshire Hathaway. Fast forward about 15 years later to 1985, the last textile operation under Berkshire Hathaway actually shut down. And then Berkshire Hathaway essentially turned into a conglomerate holding company, which would buy private companies and shares of publicly traded companies. Some of the private companies over the years that Berkshire Hathaway bought include Geico, Duracell, Dairy Queen, Fruit of the Loom, and Pampered Chef. And then some of the public companies that Berkshire Hathaway owns shares in include Kraft Heinz, American Express, Coca-Cola, Bank of America, and Apple. And you can buy shares of Berkshire Hathaway. There's two options. You can buy BRKA, that's the A share, or BRKB, which is the B share. The B share is a lot less expensive. Now get this, in 2010, Warren admitted his biggest investment mistake was actually buying Berkshire Hathaway because, as he said, it denied him the compounding investment returns of over $200 billion over 45 years. He said he should have just invested in insurance businesses. Now, as of July 2023, you can buy Berkshire A shares, which are $532,000 per share, or Berkshire B shares, which are a little more affordable at $349 per share. I want to jump in a ticker and show you what that looks like. So you can see Berkshire Hathaway is watch. The score is 61 out of 100, which is pretty good, but the margin of safety is 0%. Now, I look at Berkshire as a stock that is probably more similar to an index fund. We talk about this at Ticker. If you're in a position where you want to protect your wealth, you should be looking at ETFs, index funds, or mutual funds. But if you really want to accelerate your wealth building process, that's when you go into individual stocks so you can grow a lot faster. So I'm looking at individual businesses that Berkshire owns, such as Apple and American Express. You're probably going to get a lot bigger returns with those stocks as opposed to owning Berkshire. Berkshire is still a good company to own, but again, great for those of you who just want to really protect your wealth. The lesson learned here is if you want to accelerate your wealth building process, own a focused portfolio of about 10 to 15 stocks. Both Warren and Charlie have recommended about 30 stocks or less. If you own too many, you'll create diversification, which is better for wealth protection, not wealth building. If you like this video, hit that like button. If you want to see more videos like this, hit that subscribe button. And if you want to see some of the stocks I mentioned in this video, like Coca-Cola, Apple, American Express, and of course, Berkshire Hathaway, you can join Ticker for free. All right, we'll see you in the next video. Bye for now.